Let's get started, guys. So first what we're going to do is talk about what a stock is, how the stock market works, and how stocks are created, right? So for you guys that don't know, a stock is an investment. That's what it's created for. That's what it is, right? So as opposed to cryptocurrency, and I'll talk about cryptocurrency. Like cryptocurrency wasn't created as an investment; it's a currency, right? So we can't invest in it. We can put money into it and get money back, right? But a stock, it was created solely as an investment, right? That's what it was created for. It was created for people to make money on it, right? So investors purchase stock because they think a company is going to go up in value, right? But why would we care about the company, right? Why do the stocks have any relation to the company? It's because a stock is fundamentally and simply an ownership share in a company. So if I buy a share of Amazon, if I buy one share of Nike, I buy one share of Wayfair, right? That stock means I own part of that company. I own part. That's what it means. So I have all the rights and responsibilities that come with owning that part of the company, right? So when a company's value goes up, I receive profits, right? Because I own part of a company whose value has went up. If a company is more innovative, if it's smarter, if it's more profitable, I get money back on that because I own part of the company. That's what a stock is, right? So when you own a stock, you're called a shareholder. That means that you own part of that company. You're a holder of a share in that company, right? So collectively, 51% of the shareholders say, look, we don't want the CEO no more. The CEO is gone. The shareholders collectively have more power than anybody else in the company, right? Shareholders can kick out the person who created the company. We saw that, and some of you guys are old enough, when Steve Jobs created Apple in the 80s, right? Steve Jobs created Apple in the 80s. They sold shares. We're going to talk about that process later. But when the shareholders, the people who own shares in Apple, decided they don't want Steve Jobs anymore, the owner and creator of the company, they fired him. So the shareholders have a lot of power collectively. One shareholder doesn't have a lot of power, but when they all connect together, they all can vote, they all can make decisions, they have power when it comes to the company. So this is what a stock certificate is, right? And a lot of people don't know when we're selling stocks, nobody knows what that is, right? When you understand what a stock is fundamentally, it's easier for you to make decisions. Because if you just think of it in the abstract, you think of it as something just being traded back and forth electronically, you don't know what you're doing, you don't know what you're selling, so it's hard to make decisions. But when you understand what you're selling, you understand what you're buying, you can make decisions. You understand that you're buying a piece of a corporation like Apple. So this is what a stock certificate looks like, right? It's a piece of paper, looks a lot like a check, has the same security features as a check, has signatures on it. It says that you own 1% of Apple, one share of Apple, right? So when you trade on Robinhood, when you trade on Stash, when you trade on E-Trade, these companies hold these stock certificates for you. You don't have most of you guys, 90% of you guys will never see these stock certificates, right? Because you're gonna be just in Robinhood trading it back and forth, pressing buttons. But I want you to know fundamentally what you're trading. So Robinhood holds these in your behalf. If you go to Robinhood and say, look, I don't trust you with my stocks anymore. I want to withdraw my stocks. You could do it just like you could withdraw a check. Go to a bank, close your bank account, they give you a cashier's check, right? It's the same type of situation. You can go to Robinhood and say, look, I don't want to be a part of you guys anymore. I want to withdraw my shares. They print you out a stock certificate, they FedEx it to you overnight, and you get it. They charge a fee for that, but they have to allow you to withdraw your shares. You can deposit them somewhere else. So it's just like money, just like cash. And then I'll tell you, they look like checks. I've gotten them before in the mail. And that's what you're trading back and forth. So these companies like E-Trade, Robinhood, Stash, they hold them on your behalf, right? And you can request them anytime you want to. But most of you guys, like I said, will never actually request them, never actually see them, because it's a lot easier, a lot frictionless. It's easier to sell when they're electronic, right? So a lot of you guys, I just want you guys to know what you're selling and what you're buying. So this is what you're buying and selling, these stock certificates that are held somewhere in your name. Any questions so far, guys? No questions, guys? Okay. So stocks, and I got a question today in my messages, right? So my DMs on Instagram. People message me on Instagram, LinkedIn, Facebook. They always ask me stock questions. I can't give specific stock advice, but what I can do is I can help you through the process, and I don't mind doing that to people. So somebody wrote me and said, "Hey, I'm trying to sign up for Robinhood. Why are they asking me for my social security number, my place of work, how much I make, and all this stuff? Are they trying to steal my data?" No, that's not what's happening. The reason why these brokerages, they call them, and that's Robinhood, that's E-Trade, that's Ameritrade. These are places that allow you to trade stocks, right? They're called brokerages. They ask for this information because stock trading is highly regulated. What that means is that there's an entity, there's an organization in the federal government called the Security and Exchange Commission. They look over every trade that ever happens, right? So if you trade a stock, they get a copy of that. So the IRS and the SEC get a copy every time you make a trade, right? It's for taxes also, Sade. I hope I'm saying your name right. But it's also it's other things that we talk about in an advanced class. But there's ways you can manipulate stocks too. So they watch for that kind of stuff. They watch for fraud. They watch for different things like that. So every trade gets reported to them. So in order for them to track every trade, they need all the information. They need your social security number, place of work, because sometimes where you work at, let's say, for example, you work at Amazon, right? And you hear information before the general public hears for it, you can trade stocks based on that information. So they have to know where you work at. They have to know how much money you got. And we're going to talk about that later, why they need to know that. They need to know all this information because stocks are regulated. So they're not trying to steal information. They're not trying to do anything. They just need that information because the federal government obligates them to get that, right? So each state also has its own commission, right? So all 50 states and some of the Puerto Rico and a lot of other territories or whatever have commissions also. So that's the reason why they ask for this stuff, because stocks are regulated. So how do stocks come into being, right? So where does this stock come from? We talked about the stocks as certificates. We talked about stocks as pieces of paper. We talked about stocks trading on the New York Stock Exchange. So I have a company. I'm sure some of you guys out there probably have companies too, or you've had a company, you have a friend that has a company. Why can't I put a stocks on the stock exchange? Why can't Sade? Why can't the person down the street with a restaurant, with a Korean restaurant or a Chinese restaurant, why can't they do it? It's because there's a difference between two types of companies, right? There's public and private companies. So a private company, that's what that Korean shop down the street is. That's what that river repair shop is across town. That's what the gym is down the street, is because these are private companies. That means that a private company cannot sell shares to people in the public, right? So a public company stock is available to the public, and it has to follow SEC, the Security and Exchange Commission regulations. Private companies don't have to do that. So, but what limits you in being a private company? For example, if I start a company right now, a tech company, and I asked all you guys for investments, legally I can't do that unless I verified that each and every one of you are worth over $1 million and have 2 years of $200,000 income. That's what's called the accredited investor law, right? A private company, like the shop down the street, like me, if I start up a tech company, whatever, cannot seek money from somebody that's not what's called an accredited investor. That means somebody has a net worth of $1 million, not including your house, and at least 2 years of $200,000 income. So what this does is it limits private companies, right? There's only so many people out there with $1 million income, right? So if I want to raise money, I'll give you a good story, like Uber. Like Uber started in San Francisco roughly 10 years ago, right? So there was two guys, they saw inefficiencies in the taxi market. So what happened? They said, look, our company's growing fast. We created this new app, it's growing fast. So how do we get money? Well, we can get money from accredited investors, people with that $1 million or $200,000 with 2 years of $200,000 income. So they got money for people like Beyonce. They got money for people like Jay-Z. They got money for people like Leonardo DiCaprio, right? These rich people, these rich celebrities put money in the Uber early. They got the shares for about 30 cents each, right? So as Uber grew, got bigger and bigger, they needed more and more money to fund their operations, right? There comes a time when a company grows so much that there's not enough rich people. They need billions of dollars, right? So what they do is they have to seek money from the public. People that are not worth $1 million and people that do not have 2 years of $200,000 income. That's what's called going public. So when a company goes public, it's a long process with the SEC. The SEC, Security and Exchange Commission we talked about, has to make sure the company doesn't have any fraud, make sure the financials are straight, make sure nothing's going on, and then they set a price. And then that's when you can buy the shares on the New York Stock Exchange and the NASDAQ through Robinhood or whatever, right? And they use that money that comes to it to fund business operations. But you remember, with the Uber example, when Uber went public and when the stocks were available for regular people to buy, the stocks were $30 each. And how much did I tell you Jay-Z and Beyonce got their stocks for? So anybody remember that? And other rich people. When Uber first started, they put their money into those companies. Did somebody tell me how much I said Jay-Z, Beyonce, Leonardo DiCaprio got their Uber shares for? 30 cents, right? So when Uber went public, it was $30. That's what? How much? That's 100 times gain in your money, right? So a lot of Jay-Z and Beyonce's worth right now is from that initial Uber investment. You guys can research that. You can look it up. So the people who had access to those companies early, the accredited investors, they make the most money. And I don't believe in that law because I knew about Uber 8-9 years ago, but I didn't have that. I wasn't worth $1 million back then. I am now, but I wasn't back then. So I couldn't get into that company, right? So I think this law, I want you guys to know that these laws are out there because a lot of people, I think 95% of people don't know that law is out there. You cannot invest in private companies when they first start unless you're worth $1 million without your house. You can't include your house equity. That doesn't count. It has to be $1 million somewhere else. And I think I don't like that law because I think it's made to stop people from getting rich, right? Keep the rich richer, stop the poor man from getting rich, right? But I just want you guys to know that accredited investor law is the reason why they're public and private companies. That's the reason why companies go public. That's the reason why stocks, that's the whole reason why. And the government says they have it there to protect people who don't have enough money to lose. Like if you make $50,000 a year, the government thinks you don't have enough money to lose any in case one of these deals go bad, so they try to protect you. That's what they say. I don't agree with that. So once this company goes public, right, then that's when we can buy it, right? So if you look at the timeline of Uber, right, the Uber stocks were only available up until about 2 years ago. They've been selling Uber stocks for 10 years, but the public didn't have access to it until 2 years ago. So now we're going to discuss. Any questions so far, guys? No questions? Okay, let's move on. All right, so now we're going to discuss buying and selling stocks and the different ways we can do it, the different ways we can control our risk and keep our profit going, right? So before we start, I want to just make sure, I want to tell you guys some small tips on when you buy and sell stocks, right? And there's people how many of you guys have heard of day trade? Anybody heard of day trading? All right, so what day trading is that people buy and sell stocks within the same trading day to make money, right? So we don't talk about that. I don't talk about. I did day trading in my 20s, and I made good money doing it. But what the problem with day trading is that it takes it's like a job, right? You got to sit there all day trading and buying stocks, watching the tickers go by. It's a lot of work. So if you guys follow me on Instagram, I'm about passive streams of income, right? I have one main job. I'm a tech entrepreneur. I create apps. We have a company, a research and development company that we focus on emerging technology, blockchain, AI, things like that. So I have my time during my day filled up with that, right? So anything I create on the side, real estate, stock market, cryptocurrency, I want to make sure it's passive. I don't want to spend any more time. I want to spend time with my kids. I love technology. I want to spend all day in front of a terminal watching these numbers go by, right? So that's why I take advantage of time, right? And this is what Warren Buffett says. Okay, so Miguel says, is this recording going to be available? So, yeah, so I'm recording it right now. So when it's over, you guys should get a copy with the entire presentation. So back to what I was saying is that, okay, so when investments, right? And I use the same as Warren Buffett. I use the same as every other person on the Forbes 100 list, right? There's no day traders on the Forbes 500. And the reason is because day trading takes a lot of time, right? So the people like Warren Buffett, people like that took advantage of time, right? That's the easiest way to trade. Make a trade, sell it a year or two later. Make a trade, sell it, maybe, a month later. I don't like day trading anymore. It takes up too much time. I made money when I was doing it, but I make more money now trading. And another thing is to invest regularly, right? Anytime you have extra money, especially with these stimulus checks and bonuses coming out from different companies, these are great opportunities to invest that money if you don't need it, right? Anytime some money comes to me that I didn't expect, I always invest it, always. Because my budget and everything I have is not, that money wasn't supposed to be here anyway, right? So my budget is already set, all my bills are paid. So I take that money and invest it immediately, right, in something. I don't leave it in the bank, I always invest regularly. I invest as soon as I get some money, as soon as I get some extra money from anywhere, right? If I actually, sell a car, anything like that, I'm gonna invest that money, right? Set it and forget it, right? Don't keep looking at the stock all day. That drives you crazy. I'm telling you right now from experience. If you buy a stock and you look at it every 5 seconds, it will drive you nuts, right? And then it'll start getting into your head, and your emotions will be affected, and you'll make bad decisions, right? Maintain a diverse portfolio. That means companies of different sizes, geographic locations, and industries. And we saw what happened with the Corona crisis, right? We saw that if somebody had a heavy portfolio, a portfolio simply means a group of all the stocks that you own. That's your portfolio. Every stock that you own, in like a big folder, like that's what a portfolio is, right? So it's like all your stocks are in there. So everything you own, right? So let's say all of the stocks you bought, you went crazy on travel stocks, a year ago. You bought Delta, you bought Hilton Hotels, you bought American Airlines. You put everything in travel, right? So as soon as travel fell, you lost half your money, right? Because your portfolio wasn't diverse, right? You have to have different companies, different. You don't put all your money in one stock, right? You don't put your whole life savings in one stock because if that stock falls, you're not going to have any money, right? So we always make sure it's a common law is to diversify your portfolio. And we want to include dividend and non-dividend stocks, right? We'll talk about what those are later. So where are stocks bought and sold, right? So there's two main places. It's called the New York Stock Exchange and the NASDAQ, but there's also a third place. How many of you guys ever heard of penny stocks? Anybody ever heard of penny stocks? All right, so what a penny stock is, it's a stock that drops below a penny or always been under a penny. So the New York Stock Exchange, the NASDAQ, the major stock exchanges don't want stocks under a penny. If they're under a penny for too long, they send them to a third place called the OTC, over the counter they call it, right? So penny stocks are stocks which are under $1 that don't meet the financial or any other requirements to be on the major stock exchanges, right? There's people who dabble in this, make a lot of money, but you got to remember, and I tell people with business, whatever, with business, stocks, investment, whatever, if there's a potential to make a lot of money, there's also potential to lose a lot of money. And people don't really think about the downside of things, right? Is that if you can make triple your money on a penny stock, you can also lose everything. That's how they work, right? So I used to deal with penny stocks. I do actually own some penny stocks, actually a lot of them, because we sold, I told you I own a tech company, and we sold one of our apps to a publicly traded company from Canada. And partially of what they paid us was in stock. So 10% of what they paid us was in stock. So I own all these stocks in their company, and it's only like, 5 cents each share, but I own like millions of them. So, but yeah, that's the only penny stocks I own. Other than that, I don't deal with penny stocks because it's just too much risk for me. Like over the years, I've changed from being, day trader or whatever to being more of a long-term trader, right? So all stocks are exchanged through a stockbroker, right? So with Robinhood, with Ameritrade, with E-Trade, Stash or whatever, you are trading through a stockbroker, but the app itself acts as a stockbroker. So it's not like you have to call somebody and tell you don't have to do that anymore. It's all electronic, right? So the company itself is the stockbroker. So you never have to talk to anybody, anything like that. You just press buttons on the screen. So many people, most people actually own stocks through a 401k plan, right? So, and I want you guys just aware of two facts, aware of two things with your 401k. 401k plans charge you like 1.5%, 2% a year. And sometimes people's companies pay for these, so you don't see them on the statement. But sometimes if you look at your statement, there's a fee line down there. They're charging you to do this, right? So sometimes it makes more sense to manage your own money. In some cases, I'm not telling you what to do, but sometimes it does. But if you do want to manage your money through a 401k, it's something called a self-directed 401k. That means you can call your management company. You can say, hey, man, I don't want to. I think I'd rather manage my own 401k, right? And you have the legal right to do that. You can put whatever stocks you want in your 401k. You don't have to do what they say. And a lot of people don't know that these laws exist. That law is out there, and you can put whatever stocks you want in your 401k. If you want to fill your whole 401k with Apple stocks, it's up to you. You can do whatever you want with your money. And people think that they're limited by these 401k management companies. No, you're not. You can do whatever you want with it. You just have to call them and say, I want to convert my 401k to a self-directed 401k. And they have to allow you to do that. So how stocks make money, right? There's more ways. We're only going to talk about how you make money when the stock goes up. There's another way you can make money when a stock goes down, right? If you guys want to know about that, we'll discuss it at the end. But I like to stick to, we got other classes where we talk about shorting and things like that, where you can make money when the stock drops. But in this class, this is a beginner class, I only teach how to make money when the stock goes up, right? Because that's the human brain. It's easier for the human brain to understand that. I put $10 in. It goes up to 15, I sell it, get $5 profit, right? The human brain can understand it a lot easier than shorting. That's what's called shorting, is when you make money on the reverse of a stock. So if a stock drops $10, you can make money on that too. But we talk about that in an advanced class. But so how do stocks make money, right? Other than making it when the stock drops, an increase in share price, right? So increases based on profit and growth potential of that company, right? So if the company makes a lot of profit, the stock goes up. If there's a lot of potential for growth, that stock goes up. There's another way called dividends, right? You can receive a check in the mail every year just for holding certain stocks. Not all stocks do this, but a lot of the major stocks give dividends, right? So if I own a share of one company, right, every year I get 2% of my share price back, right? Every single year. Some people have a whole income based on that. They buy only dividend stocks and they get an income every year from those stocks. They never have to sell the stocks. They hold the stocks for their entire lifetime. They make an income off the dividends. So some people use this strategy, right? And then they pass those stocks on to their kids, and then the kids have a dividends, right? They have an income for the rest of their life. So there's a lot of people that do this, right? But it's up to you if you want to do it or not. So there's two types of stocks. We talked about that, right? The dividend stocks and non-dividend stocks. So a dividend stock, what we talked about, is a stock that pays you just to hold it, right? If I own a Walmart stock, right, we'll talk about that in greater detail in a couple of slides, right? Dividends are taxed as income. So capital gains income. We talk about that later. Capital gains. The capital gains. So, any more questions? All right, so there's two types of stocks, right? There's dividend and non-dividend stocks, right? So dividends are paid from the cash flow when a company has extra profits to work with, right? So if Walmart goes out this year, which I believe I think Walmart's going to do very well. We discussed that. We're going to discuss that later. Walmart is actually a good company right now. And I'm going to tell you the rationale behind that in 2 slides from now. But Walmart is a stock that produces dividends, right? You get 2% a year, almost 2, right under 2% a year just for holding that stock. So I hold $100 worth of Walmart stock. So next year this time I'm gonna get around this time or whatever. Before next year around this time, I'll get $2 just for holding the stock, right? 2% back every single year, right? That's better than a credit card. It gives 1% back, cash back, right? It's the same thing. And you can reinvest those dividends back into the stock if you want to. You can take those dividends, spend them on a vacation. You can take those dividends, do whatever you want with it. It's up to you, right? So historically, in the past, dividend stocks outperform non-dividend stocks. That means you make more money from a dividend stock than a non-dividend stock. But the problem with that is dividend stocks don't have a lot of risk, right? We know from everything else that more risk equals more reward, right? So since dividends are low risk because we know we're going to get money regardless, they also don't grow as much. They don't grow as much as like somebody like Uber, like Tesla, like Zoom. These companies go up fast, right? So somebody like Beyond Meat can go up 5 times. It came out at 25, and within 2 months it was at 200. That's like 8 times, 800% return. So a dividend stocks never grow that fast, never, right? But it's a guaranteed income. That's the reason why you mix both of them. You don't just have one. You have dividend, non-dividend stocks in your portfolio, right? So how are stock prices set, right? So where do these prices come from? Like, what are we paying for? Why do we pay $130 for Walmart? Why do we pay $800 for Tesla? Why do we pay $2,300 for Amazon? Why do we do that? Well, it's because whenever the market's open, it's an auction, right? It's just like an eBay auction. It's just like an auction that the guy stands in front of a crowd and and he says like he raises, everybody raises their hand to bid on this stuff, right? So it's the same thing except it's electronic. Same thing, right? So you have two things that happen in the stock market. There's a bid price. That means that's the price somebody out there wants to sell their stock at, wants to buy their stock at. There's an ask price, which means that's what somebody's asking for the stock. So that's a price out there that people want to sell it for, right? When those two numbers come together, a sale happens, right? As soon as somebody wants to buy a stock at what somebody wants to sell it at, the two people come together, stock is sold, right? And that's the price you see on the chart. It's the last price that stock was sold at. That's the price that you see when you look up stock quote. So whatever the last price was, if somebody bought or sold that stock at, that's the current price of the stock, the current value. That's what people see it as, right? The stock market price is based on simple supply and demand. The more people want that stock, the higher it goes. The less people want it, the lower it goes, right? And there's also other things. Supply can go up, supply can go down. They can do reverse splits. They can split. That also affects share price, but it's mostly in demand, right? The more people want their stock because they see it as being a good company. They see it as being an innovative company. They see it as the company potentially growing because of one thing or another. Like with Amazon, that people think it's going to grow. Walmart, people think it's going to grow. Just like what happened with Wayfair, people think it's going to grow. That's why it went up 27% today, right? Because people want that stock. So people, the demand goes up, the auction prices go up, and that's what causes the price of a stock to go up. So what makes a good stock, right? So why do we, on my Instagram, I post stocks that I purchased, right? So, I posted Walmart a few weeks ago. I posted Amazon a couple of months ago. Why did I post these stocks, right? What does that mean? Well, because these stocks are what's called being a good company, right? There's two ways you can identify a good company. There's a lot more to it than this, right? That's fine. That's technical analysis, all this, deep stuff. I'm just showing you guys the basic things to be able to identify if a company's bad or good, right? You can go farther. You can research more. You can do a lot more research to figure out what you're going to do with this information, right? But we don't have enough time here tonight for me to go over all the technical analysis, right? But we can go over the basic blocks of what makes a company good, right? So there's two types of companies, right? There's a company with the potential to be successful, right? That's like Tesla, Beyond Meat, other companies like that. And there's companies that are already good companies, right? Now, most of those companies produce dividends. That's what a successful business company is. That's like Walmart right now. We know Walmart's a successful company, right? So that's a good stock because we know we're going to get a dividend back. And there's something called the P&E ratio, right? That's the profits and earnings ratio. We're going to look on the next slide, and I'm going to show you how you can find that and identify it, right? So if that company's under 25, we like to say that's a good stock. So, and then we have to check the liquidity, right? We have to check the volume to make sure the volume means, the liquidity means the amount of people that buy and sell that stock within a given day, right? And the reason that's important is because if there's nobody buying and selling the stock, if one day in the future we try to sell it, nobody's going to be out there to buy it. And that's what happens a lot with these penny stocks is that you may buy a stock. It may say it's worth $1 on the screen, but the volume's zero. Nobody's buying it. There's no interest in anybody buying it. So if the last sale was $1, but nobody wants to buy your stock, it's worthless. It doesn't matter what it says on the screen. And that's what happens a lot with penny stocks. That's the reason why we have to check the liquidity. to make sure we can get in and out of a stock. We can buy it, we can sell it with no problem, right? Low volatility. That means we don't want the stock bouncing around, 20% up, 20% down, 30% down, 30% up, because we don't like that. We want a lower risk, right? So, and also a company, like I said, with the potential to be successful, right? So the risk is higher, like with a Tesla, like with a Zoom. With these types of companies, the risk is higher, but also the reward is higher, like with an Uber, right? So we're going to do a quick Walmart stock evaluation, right? So a few months ago, I put out, I posted I was buying Walmart. The price was about a little bit lower than this. It was like 108, 109, right? So I said, hey, man, I'm buying Amazon. So why? I'm sorry, I'm buying Walmart. So why would I buy Walmart? What's so good about Walmart? Out of all these stocks, why would I start buying Walmart? Well, I had an initial conviction, right? I did research on the company itself. So I know that we're more than likely going into a recession, almost guaranteed, right? Because of the corona crisis or the COVID-19 crisis, as people like to call it. So we know that something's about to happen there with the economy, almost guaranteed. People are not working, people are not paying their mortgages, people are not paying their rent. It has to be consequences of this. It has to be, right? So we're going to go into maybe a recession, right? So what I did is I looked back into history. When's the last time a recession happened? So a recession happened in 2008. So what I did is I researched all the companies that did well in that recession. And you got to remember, this is still a valid research technique you can use right now. If you guys do research on all the companies that did well right after 2008 financial crisis, you'll find a whole bunch of stocks that you can buy right now and probably do well in, because history repeats itself, right? So what I did is I looked back at those companies and said, what companies did well? Well, one of the ones that stood out to me was Walmart, right? And the rationale behind that was that when there's a recession, right, the people who shop at Walmart continue to shop at Walmart, right? But there's something else that happens. People that shop at Target, people that shop at Whole Foods, people that shop at these higher end stores, they lose their job, the incomes drop, and they have to search for value, right? That's why I talked about Dollar General, Walmart. These types of stores, Dollar Tree, are going to do well in the recession because people will be forced to shop for value, right? So that's my initial conviction. That's my initial research. So what did I do after that? Well, I looked up Walmart and I said, hey, let's look at the financials. That means looking at the data to make sure that it looks okay, right? So the first thing we looked at, we talked about this, as I looked at this, we look at the, let me get my pen out here. First, we look at the price, 119. So I say, hey, man, that's, the price is good. So how do we know if that's a good price? Well, I always look at the 1-year target estimate down here, right? The 1-year target estimate is a group of analysts from all over the country, right, that get together and they decide where this is going to be in a year. Where is this stock going to be in a year? So the consensus of those guys said it will be at 129 within a year from now. It's higher than the price I see on the screen, so that's good, right? So people agree with me. There's people out there that agree with what I'm thinking, right? So that's good. This is not always right, but it's right in a lot of cases. It's right in most cases, right? So I like to go by this, right? So the second thing, I look at the forward dividend yield, right? It's 1.82%. So every year, I'm going to get at least 1.82% back on this stock, roughly, right? Every year, I'm going to get something back. The stock goes up, stock goes down. I hold the stock, don't sell it. I'm going to get dividends every year. I like that, right? That lowers the risk for me. So I look at the P&E ratio, right? It's under 25, right? So now the financials look good. It's under 25. I know I'm going to get a dividend. And the 1-year target estimate is higher than what the current price is, right? So now I got to make sure I can sell this stock. So I look at the average volume, right? It's almost 9.5 million shares of Walmart stock get traded back and forth every day. So I know I'm going to be able to sell it if I want in the future. Somebody out there is going to want this stock. So that's good, right? So the last thing I look at is the 52-week volatility, right? It's a tight range in there, right? So it's not dropping too bad. It's not going up too bad. So that means I'm not going to wake up one day and be down 50%, be down 60% because I know the volatility is tight, right? I don't like dealing with highly volatile stocks. Volatility simply means the amount of stock goes up and down in a given time period. I don't like stocks to go up 40, 50%, back 40%, up 40%. I don't like that. I like stable stocks, right? They go up steadily. So with all of that, I realized Walmart was a good buy. I bought it a month ago. Right? It may have been like 5 weeks ago. Any questions so far? No questions, guys? What's the range for 52 week? Okay, so 52 week is the price of the stock within the last year. So within the last year, if you look at this Walmart example, the lowest the stock ever got was $98, $98.15. The highest it ever got was 128.08. So what that does is show us that the odds are the stock's not going to drop much lower than $98. So even if it goes bad, I'm not going to lose that much money. I'm not going to. Some stocks go 50, 60% down, and 50 to 60% up. You got to be careful with that. Like if you look at Beyond Meat, that range is probably crazy. So I like more stable stocks when I'm building a long-term portfolio. Any more questions? Did I answer your question, April? All right, let's move on. So how do you buy a stock? And we talked about these three things. We talked about checking the financials. That means the P&E ratio, the 1-year target estimate, the forward-year dividend yield. That doesn't have to be there, but it makes the risk lower. Some companies like Amazon don't give a dividend, but their stock goes up so fast, you really don't need a dividend, right? And then we got to check the volatility. We check the liquidity, make sure the stock, we can sell it in the future. We check the volatility, make sure it's not bouncing around too much. So then we go and we buy get a broker account. Like Rob, I always suggest Robinhood, I always suggest Stash. Because these companies have good user interfaces and they help people that are just starting out, right? So it's an easy to use interface. It's not too complicated, but it's a nice interface for buying stocks. So I always suggest those two to people just starting out. So then you select the stocks you want, you buy the stock, right? But it sounds simple, but it's a lot of you can do it just like that, but there's different ways that you can save money. There's different ways you can reduce risk and make more profit. So let's talk about how to buy the stock, right? So this is a Walmart stock, right, on Robinhood. I always tell you about Robinhood. So Cash App. So Cash App's good too, Janelle. I bought stocks on Cash App just to test it out because somebody told me about 3 weeks ago you could buy stocks on Cash App. So I mean, the thing about Cash App though is the liquidity, the liquidity's low. So it's kind of hard to sell stocks that are not major stocks. I had a problem with that. So that's what I don't like about Cash App is that the volume's low, and that means that the amount of people buying and selling on that market on that Cash App is not that many. So if the company has a potential for success, how can you tell if it's good? So April. So with those kind of companies, you have to kind of most of those the companies with the potential for success usually don't have financials you can look at. They usually don't have you can't look at the profits and earnings and anything like that. You have to kind of understand where things are going, right? Like with Amazon, it has to be from some kind of conviction or research, right? That's the only way you can figure that out, right? So with Amazon, right, the way I knew that Amazon was going to go from 1,800 to 2,300 is that, like I said, you got to look at the current times, right? We're going into a recession for one, but the reason but you have to think about where we were at a month ago, 2 months ago, right? The coronavirus was coming up. People were going to be forced to stay at home. So I thought, people are going to have to order all that stuff from Amazon, obviously. Most people are going to, when they get those stimulus checks, they're going to spend it on Amazon. So it's going to cause their stock to go up, right? So that's what led me to buy Amazon. It wasn't like I analyzed anything. It wasn't like I was able to look at numbers because it's hard to do that, right? Because Amazon doesn't even produce a dividend. You have to understand what the market is like. So another good one is Dollar General, Walmart. You research these yourself, you guys. I implore you to research this stuff. Research right now companies that provide value, right? Walmart, Dollar General, Dollar Tree. companies like that, because we're going into a recession, right? So to go back to 2008 and just put in Google what stocks did well in 2008, right? And then look that up, right? And see, and then try to make a prediction based on that, right? Because that's what we're heading to, a recession, right? So go back to the previous recession. I think it was like 2001. I don't know when the other recession was, but look at all the recessions in the last 20 years and try to figure out what stocks did well. And then now I promise you, in most cases, it's going to repeat itself again. So we go on Robinhood. We look at Walmart, right? We got a P&E ratio here, and we got our 4 dividend years. Every brokerage has this information. This is not specific information to Yahoo Finance, right? Everybody has it. So the volume on this one is 12 million. So we know we're going to be able to sell the stock, right? 12 million is a lot. Every day, 12 million shares get traded. So, we're not going to have a problem selling this Walmart stock. So what we do after we look at that, we press the trade button, right? Then we get brought to this screen here. So this screen lets us put in our number of shares. We do the market price. And we get an estimated cost, right? So the reason why it says estimated cost is not real cost is because we're doing what's called a market order. A market order, and every time you buy a stock, there's different ways that you can buy it, right? The most common is a market order. That means whatever the price is right now, I'll just pay for it. Whatever the highest auction price going right now, that's the one I'll take, right? That's like you walk into a store and you didn't negotiate for the car and you just bought the car for whatever it was, right? So a lot of people do this because, if you got extra money and you want to walk to a car lot, buy the car and walk out, you may just want to do it for convenience. You may be like, I don't want to wait all day and negotiate with this guy. I'll just buy the car and walk out. But what if you want a better deal? What if you want to have more control there? There's other order types you can use, right? Market order is the one everybody else uses, but there's also a market order. There's your limit order, there's a stop order, stop limit order, and there's a trailing stop order. Right? These are different order types you can do to control your risk and gain more profit, right? Let's say you don't want to pay the 119, 114. You say you've been watching Walmart all day. And you say, man, Walmart's going down. I think it's going to go down to 118, right? You don't have to pay the 119. You can say, hey, look, I want to put in what's called a limit order, right? So that means I want to set the price myself. I want to say, I don't want to buy Walmart stock unless it drops down to 118, right? So if Walmart stock doesn't drop to 118, I don't want to buy it. So you put in an order type that says, but I want you to automate this trade. I want you to say, I don't want to buy Walmart until it drops to 118. You put the order in, you walk away, right? So when Walmart reaches 118, you get an email that says you just got Walmart for 118. You didn't have to sit there watching it all day. You didn't have to sit there, watching it, with your hand over the buy button. You set it and walked away. It can happen today. It can happen tomorrow. It can happen next week. It can happen next month. And you get your stock for the price that you want. You don't have to pay what's on the screen if you think it's going down, right? So this order, this gives us the power. This gives us the flexibility. It gives us the insight, everything to buy these stocks at what we think the price should be. Right? We think the price should be lower. We put that order type in, we walk away. And there's other ways to do this. There's another one called a stop loss, a stop order. And that's used to limit the amount that you lose if the trade goes against you, right? We go back to that Walmart example, right? We bought Walmart at 119, right? Let's say we're going to go to work the rest of that day, right? So we're not going to be near a computer. Our phone's going to be in a locker somewhere. So we're not going to have access to the stock market. What we could do is we can say, look, if Walmart drops below 100, I want you to sell my stock. Otherwise, keep it, right? So Walmart goes up to 120, goes back down to 118, and then it goes down all the way down. Let's say in one day something bad happens to 80, right? Because you had that order in at 100, you sold your stock at 100. You never took the full loss because you had an automated order type in for 100 to sell if it went to $100, right? So it protected you against the dramatic loss that could have came, right? But there's another one, and the next one we talk about is my favorite one. It's called the trailing stop, right? This is the one I use mostly. I use this almost on all my trades, right? What this does is that this trailing stop is like the stop loss, except it's adjusted upwards as the trade moves in your favor, right? So go back to that example. We bought Walmart for 119, right? So we can put in a trailing stop. We say, look, if Walmart, we don't put in a hard number. If we go back to this one, we put in a hard number, 100, no matter what. It didn't matter what the stock did. 100 was the limit. That's what we were going to sell, right? So on a trailing stop, we set a percentage or a dollar amount. We say 119, if it drops less than $5, I want out, right? So at this point, your trailing stop loss is 114, right? Because it's $5 less than 19. Let's say the price goes up to 125, right? Your stop loss gets adjusted to 120, $5 less than 125. Goes up to 130. Your stop loss gets adjusted to 125. Goes up to 135. Your stop loss gets adjusted once again to 130. Goes up to 150. Your stop loss gets adjusted again to 145. And then it goes all the way down to 100. Say something happens. Well, you sold at 145 because your trailing stop went up with the profits and sold as soon as it dropped greater than $5. So you see how this stop order can make you gain profits, but also completely reduce your risk if it drops. And this is an order type, right? So most people buy and sell stocks with buttons. You can use these order types to automate your trading. This can all happen while you're at home, while you're sleeping, while you're watching Netflix, while you're out playing basketball, while you're with your kids in the park. You don't have to be there watching this stuff all day. It does it by itself. So it gives you the power, gives you the flexibility to create a passive, like we always talk about, we talked about in the beginning, a passive stream of income. You set these and you forget it. This can happen over a day. It can happen over a year. It can happen over 2 years, right? You don't have to sit there and watch it every day. You don't have to sit there and decide what you're going to do. You make the decision when you bought the stock. So you make your decisions, you set your strategy, you walk away, right? So that's what the power of these different order types are. Any questions on that? No questions? Guys not asking a lot of questions. All right, so we'll move on. So when you sell a stock, right, you have to do, there's a few things you have to do, right? You have to use your order types. We talked about that. You have to make sure the order types allow you more flexibility, more power, but they also do one thing. They let you remove your emotions from these trades. If you sit there with your finger over the button, you're going to make a mistake. And the reason is because you let most of the time, if you sit there and you're watching the trade go back and forth, you watch the stock go back and forth, you're way more likely to make a mistake because your emotions get involved. Nobody is immune to this. Everybody gets caught up by this, right? So you have to be able to control your emotions, right? And the way you do that is through those order types. You use the markers, use your stop loss, use your trailing stops, use your limit orders to stop yourself from making a dumb decision in the future, right? Everybody does this. It's nothing. This is the stock market has two emotions, right? And if you guys ever saw video of the stock market trading floor, you'll see how emotional and how wild it is. It's because that is a very, very emotional place, right? There's two emotions, greed and fear. And no matter what, people get caught up in one of those. If you sit there and watch the trades all day, if you sit there with your finger over the button all day, you will get caught up in this. Guaranteed. Everybody will. Then you will make bad decisions, right? That's how a lot of people get caught up into this because they don't know how to separate their emotions. You have to separate yourself from the trade. And that's how you deal with these limit orders. That's how you do it with the stop losses. That's how you do it with the trailing stop losses. So now, mostly up until this point, we've talked about only stocks, right? Buying, selling stocks. So we talked about the certificates. We talked about the pieces of paper. We talked about what a stock is, right? So we've only talked about that. But there's other ways you can invest in the stock market without directly investing in a stock, right? We talked about stocks. We talked about having an ownership share in a company and selling it once the price goes up. But there's two other things. There's buying mutual funds and then buying options, right? So how many of you guys have heard of mutual funds and options? Yeah, I guess this is a smart class, Sade. All right, so mutual funds are simply mean buying a share in a group of investors, right? So what a mutual fund does, they go out and buy all these stocks, right? Amazon, Nike, Facebook, or whatever. They put them into a group. They sell you shares of that, right? So you get pieces of all of that, and they sell you shares of the group. That's all a mutual fund is. Options are buying contracts of an underlying stock. And this is, I'm going to explain to you in an easy way. Stocks are the most exciting, most profitable way to do trade stocks, right? It's a beautiful, beautiful way to trade stocks. I'm going to show you we do options all the time and don't even realize. We use options in our normal day and we don't even realize it. I'm going to show you how options are able to make so much money, make so many. They also have a lot of risk too, without ever having to actually own the stock. It's the most exciting, most beautiful thing in stock trading to me. So so mutual funds, like we talked about, allow an investor to purchase a large number of stocks in a single transaction, right? So it pools money from many investors that ran by a professional manager who has a license from the SEC, who normally has a lot of experience in stocks, and it follows a set strategy, right? So most 401ks, most things, retirements invest in mutual funds because of the low risk and almost steady return, right? So, but because of that, a lot of people have some experience with mutual funds. So this is people that don't want, we're going to talk about this later. You have to know what kind of investor you are. If you don't want a lot of risk, mutual funds may be right for you. Especially for retirement, especially for stuff like that. Depends on where you are in your life, how old you are. As you get older, you have less and less risk, right? So mutual funds may be a good way to go. But this is the most exciting part of options, right? What an option is. So an option is simply the right, but not the obligation to buy a stock at a certain date at a certain price. That's it, right? So let's talk about what an option is, right? So remember, options are sold just like stocks. So I can open up my Robinhood account, I can press a button, I can start buying options. Like I can buy stocks, same thing. I press a button, I sell it, press a button, I buy it. It's the same thing, right? But what is an option? What is that? Why are the prices cheaper? Why do the prices vary more than a stock? Well, I'm going to tell you I'm going to give you an example of what an option is, right? And I'm sure how many of you guys have bought a house before? Anybody bought a house? Nobody. Okay, so April's bought a house. So was it okay? So I'm gonna give you this house example because most people have an experience with houses. So I'm gonna give you the house example, right? So with the house, right? Let's say I'm driving down the street, right? And down the street from my house, I see them. They built a brand new housing development. I'm like, man, I really want a house in that housing development, but I'm not sure, But so I go into the development office. They're like, hey, man, we can sell you this plot. It's a nice plot near the entrance or whatever. Well, you have to pay $5,000 down for a deposit. But look, if you don't buy the house, we keep the deposit. I said, okay, that's cool. Well, now I paid him $5,000 and I have the right. So we signed a contract saying, look, in 2 years, you're gonna have to pay. We're gonna build you a house over the 2 years, but you got to pay us $500,000 when the house is done because that's what it costs. All right, man, that's cool. So I give them $5,000, non-refundable deposit. I said, here's the $5,000. Right? I signed a contract. I said, when it's over, I can buy it, but I can walk away. Remember, because that's what the deposit's for. So if I decide to walk away, I just lose my deposit, right? But somebody else buys the house. So let's say during those, so I signed the contract, walk away, right? So I paid them $5,000. Now I hold a piece of paper that says I'm going to buy this house in 2 years. I have the right to. But if I walk away, I lose the money. All right, that's cool for me. So let's say in 2 years, right? 2 years from then, around in that area, the housing market skyrockets to 900,000, right? So if that happens, now I got a piece of paper at home that says I have the right to buy that same house that's worth $900,000 for $500,000, right? So let's say that now the deposit locked the price in. I paid the $5,000 to lock that price in, right? So they have to sell it to me. That's what we signed. That's my option to buy it, right? That's why I paid for that $5,000. So now I have a piece of paper and an option. Say option contract. That's what it is in stocks. An option contract that I have the option to buy this house for $500,000, even though it's worth $900,000, right? Because we didn't know what was going to happen 2 years ago. It just happened, right? So let's say I say, man, I like my house I have now. I don't want to move to another house. I don't know what I was thinking, but man, I don't want to give up this deal because I got a contract that says I could buy this house for $500,000 when all the houses around it are worth $900,000. So what am I going to do? Well, I find a real estate agent. I said, look, man, I got this contract to buy a house for $400,000 less than the value. I'll sell it to you for $300,000. So what real estate agent wouldn't take that, right? They're going to get a house for $100,000 less than the value. By they can give me $300,000, they still buy the house for $100,000 less. So now I give them the contract. I sign the contract over to them. I sign the option over to them, and they buy it from me for $300,000. I made $300,000 off a $500,000 investment without ever having to take delivery of the house. See what I'm saying? That's how a stock option works, right? You pay a down payment for the right to buy stock in the future at a certain date, a certain price. When the price goes past that, you sell that option and you make 10 times your money sometimes in some cases. You guys understand that example? If not, I'll try to figure a different way to say it. Here's a little cartoon of it, right? So I never sold the actual house, right? I was going to buy the house, but I changed my mind. So I sold somebody else, the real estate agent, the contract to the house, right? I never bought the house. That was what's called the underlying asset. I never bought that house. What I did is I bought the option to buy the house. Then I decided I didn't want it, and I sold it to somebody else. That's the same thing you do with stock options, right? So if I buy a stock option, let's look at a Walmart example, right? So let's look at a Walmart example, right? So let's say Walmart's current price is $123, right? That's the current price of Walmart. That's what price it is right now on the stock market, roughly, right? So let's say for June 3rd, July 3rd, I buy the option to buy Walmart stock on July 3rd, right? That's 2 months from now, roughly. So 2 months from now, I'm going to buy Walmart stock for $130, right? It's over the price. It's like with the house example, right? So let's say during that time, right, Walmart's price I bought an option. I pay like 97 cents. I pay the guy a down payment of $970, right? This all happens electronically. I don't have to go out and find people to do this. I press a button on my Robinhood app and I get the option because people sell them electronically. So you never have to, see anybody, touch anybody. It's the same thing as buying a stock. You just press a button. So I paid $970. I paid a down payment to buy these stocks. I have the option, right? I bought 1,000. I got the option to buy 1,000 Walmart stocks for $130 on this date, 703. So let's say before that date, Walmart's price skyrockets to $150, right? So now, in basic terms, I control that stock because I have the right to buy it on that date. I control the stock. So I control, just like I controlled that house, right? I was the only one that had the contract to buy that house. So in all terms, all the terms, I controlled that house. Nobody else could buy it during that time. Nobody else could live in it, so I controlled it, right? So it's the same thing with the stock. I control it until the option date expires, right? So during that time, let's say Walmart stock skyrockets to $150, right? I only paid the guy $970 for the down payment. That's it. So now I can sell those options, not the stock itself, but the option to buy them to somebody else for $20,000. Right, because that's the difference in what the stock is worth, and what all I have to pay for. All I gotta do is pay $130 for these stocks. The stocks are worth $150, so I sell it to another guy. I press buy, sell on my Robinhood app. I just made $20,000 off a $970 investment, right? And the stock only moved $6. That's it. So if I would have bought the stock itself, I only would have made like 4%. But because I used options, I made way more money. You guys see what I'm saying? Any questions? And I have an advanced class in options this weekend. If you guys are interested. We don't talk much about options in this class. So now we're gonna terminate this class with taxes and risk assessment. So April's confused. All right. So let's make sure we get her on track. So what are you confused about, April? I want to make sure you guys understand it. So let's do a what you call. Let's draw it out. Let me get my whiteboard out. We'll draw it out. We're ahead of time anyway, so we got plenty of time. Let me know when you guys can see my screen. Let me know when you see my screen, and we'll do another example. How you got to 20K? Okay, so let's do a real world example, right? So Wayfair. Let's look at Wayfair. Let's look at another one. Let me see Wayfair. Look at the Wayfair stock. Let me see Google Finance. Let's look at Wayfair, right? So Wayfair was at 165 at the end of the day. Yet today. Let's look at the options, right? Let's see how much the options are. So Wayfair went up 23% today. Options probably went up 1,000. Yeah, it went up. See how much the options went up? These are the percentages on the options. So let's look at a cheap option. So Wayfair yesterday was let's look at the price. So it was at 165, take away 33. So let's go back to this morning, and we're going to do an option exercise. We get a calculator out, figure out where it was at this morning. So it's at 165.88 minus 31.77. So this morning, Wayfair was roughly 134. So it went up 34%. Okay, so all right. So let's look at some options that were out of the money. So 134. It was 134 this morning. So here are the options here. So 134, right? So this is an option that we could have bought for to buy Wayfair at 134, right? So this morning, let's pick another example, because I want to pick an example that's not hasn't already happened. Okay, let's do this. Let's say Wayfair right now is 165, right? So let's pick an option for tomorrow. So let's say 185, right? So right now, if we bought options to buy on the 5th of what's that? That's this Friday. So let's see what the expiration date is, May 8th. So these options right here say that on May 8th, we have the right to buy Wayfair at 180 on May 8th, right? So all we got to do is pay $2.82 for that, right? For 100, per 100. So let's look at let me draw out the prices. So right now, Wayfair is at 165, right? So Wayfair right now, let's say 166. That's roughly what it is. So Wayfair is at 166. That's the current price, right? But the option, let's say we want to buy on May 8th, 5-8. We can buy a contract. We can open up a contract to buy Wayfair shares for 180. Right? And we only have to pay $2.82 for the right to do that, right? Let's just do one share, so we'll know what it is. So let's say we do that. We pay almost $2.82, and we buy a contract to buy one share of Wayfair for 180 on Friday, right? So let's say during that time, right now it's only worth 208 cents because if the price never gets to 180, then we don't get it's like a down payment, right? So we're putting a down payment down of $2.82 to buy Wayfair shares for 180 on Friday. That's what this contract means, right? So options are purchasing quantities of 100, Sade, but we're just going to do one share just so you would technically the minimum price you could pay for this would be $282. But we're just going to do one share so you guys can see how it works, right? So we're going to do one share, right? So we pay $2.82 down payment to buy these shares on Friday. So if we don't want to, let's say it never reaches that price, right? So just like with that house example, if the house if the house is worth less than what we're going to pay for, we're going to walk away from that deal, right? So that's what's going to happen with options too, is that if the price never reaches 180, we just walk away and leave our deposit, so you lose your money. But let's say the price goes up to 200 by Friday, right? So if I own shares, if I have a contract that says I can buy Wayfair on Friday, let's say Friday morning we wake up, Wayfair is $200, right? So now I have a contract that says I can buy that Wayfair for 180 regardless, right? So how much is that contract itself worth? So let's say April. So let's say if I had a contract, I said, look, man, no matter what, you can buy Way shares for $180. But right now it's selling for $200. So how much is that worth to you? How much is that worth? Anybody answer that? So $20, right? It's worth $20 because we're going to get it $20 cheaper, so it's worth $20, right? So we paid $2.82, right? And we sell it for $20. That's 8 times. That's 800% gain almost. I think roughly. See what I'm saying? So we only paid $2.82 for the down payment, right? But because the price is greater than the price that's on our contract, we made $20 off of it. So that's like 10, that's like 5, 10, it's probably like 7 times, 8 times more money, right? So every $2 we put in, we pull out 20. Now you're right, $20. It's worth 20 because remember, the face price on Friday is 200, but we have the coupon for 180. Let's think about it like a coupon. We have a coupon for 180, so it's worth $20 because even if we buy the stock and we sell it immediately, we got $20. So even if we sell it to somebody else, they're going to pay us $20 for it because that's what it's worth, right? But that just shows you the power of options, right? So I only paid $2.82 for that. And if we go back and we look at how, like what happened on Wayfair, let's go back. Let me see. So we look at Wayfair here, and we look at the options, and we see that happened today, right? So Wayfair went up 23%. But let's look at how much the options went up. You see how much the options went up? Some went up 300, 400%, 400, 100, 180%. Some went up 250, one went up 300%. Options go up a lot faster than the underlying price. Because of that, one went up 400% here. It's because what we just showed you on this is that the down payment is low, but if it reaches the price that you had it based on your contract, the price on your contract, the price can triple, quadruple, go up 5, 10 times. Because options give you that much power to do that. Any questions, guys? You understand it, April? All right. So any questions, guys? But I love options because that's the kind of power options give you. Let's say I would have only bought the stock. Let's say instead of buying this, I bought the stock itself, right? So if I bought the stock itself, right, for 166, I would have never made those kind of gains as I did on the option itself. You see what I'm saying? So I only put $2 in it. I made $20. If I would have put those same $2, let's say I would have bought, let's look at this. Let's say I would have put, instead of putting 166 in the stock itself, if I put 166 in the stock and I sold it at 200, I would have only made what? $34. That's it, right? So, but let's say I put that same $166 into the option, right? So $166 gives us how many options? It gives us 166 divided by 2.82. So that would have gave us 58 options, right? 58. What's 58 times 20? So we would have made 100 off that same trade using options. So we'd have made 34 if we would have bought the stock. We would have made 1,000 if we would have bought the option. That's the power that options give you. And we put that same $166 into the option, we would have made way more money as opposed to the stock. But remember, when you do things like that, the risk is also higher because in stocks, you don't lose all your money. So if by the date that you have on your option, if the price doesn't reach it or the price, something happens like that, you lose everything. So we had the potential to lose all of the 166, right? Any questions, guys? All right, so now we're going to move on to taxes and risk management, right? And we talked about we talked about this at the beginning, but we're going to touch on it a little more. Is that you have to know what kind of investor you are, right? Because that would depend. That the type of person you are, how you can handle risk, how you can tolerate risk. That's a big factor there. Because some people can't tolerate risk. Some people can't handle it. I'll tell you a story. About 10 years ago, there was a guy who wanted to get into stocks, right? He kept asking me, Armando, man, you do pretty good with stocks. Can you help me? Can you help me? I said, all right, man. How do you want me to help you? He said, well, next time you make a trade, and that's the reason why I don't do this anymore. He said, next time you make a trade, let me know. So, all right, man, I'll do it. So I made a trade. It was a company called Giggle or something. I forget the name of it. And I told him, I said, hey, man, I just made the trade. I bought like $2,000 worth of Giggle. He said, all right, man, I'm gonna put 1,000 in. All right. So we both put our money in. And then like the entire day, he called me, wrote me, texted me, because he was so scared he was going to lose his money, right? But the price was actually going up. But he was so scared that he would lose his profits. He would lose money. The guy the whole first day, he would text me all day, ask me what he should do, what she should do. The second day, he didn't sleep that night. The third day, he didn't sleep that night. The fourth day, he was a nervous wreck over that $1,000. So he eventually sold it and made a little bit of profit. But that shows you that some people can't handle the stock market, right? So if you're like that, you need to do mutual funds. You need to do something else. Some people can't handle risk. There's no use in losing your health over this, right? Most people aren't like that, but there are some extreme cases where people can be like this. You have to know what kind of person you are. You may want an active role. You may want a passive role, right? Risk management, right? We talked about those different order types. You have to know your exit before you enter. You have to know when you go into something. It could be a business, it could be an investment or whatever. You have to know your exit plan when you get in. When you buy the stock, you already know when you're going to get out, right? So if it goes up 20, 30%, you got to know when you get out. A lot of people get stuck in stocks because they don't know when to get out, right? It's people right now that have stocks that went up 30, 40%. They don't know what to do. They're holding on to it. They don't know when to get out. They don't know when they should sell. What happens there is that if you don't sell stocks, when you don't have a preset plan, you don't know when to sell it, you end up losing money because the stock goes up, goes all the way back down under the price you paid it for. I've seen this happen a bunch of times. You have to know, look, if this stock goes up 25%, I'm going to sell it regardless. If it goes up 10%, I'm going to sell it. If it goes up, I'm going to hold it for 4 years. I want 40% return. You have to have some kind of plan. You can't hold a stock or, with no plan in mind, right? Oh, I'm going to hold it the rest of my life. You have to have something in plan. So you may want to hold a stock the rest of your life. Some people do that. That's okay. You may want to get a dividend stock and get profits on it. That's up to you, but you have to have these strategies when you buy the stock. You already have to have the strategy set. Now, you can readjust the strategy. Sometimes people do that, but you have to have something in place when you buy the stock. That stops your emotions from getting involved, right? Diversify your portfolio. Don't just buy one stock and that's it. Buy different stocks, different locations, different sizes of company sizes, and different industries, right? And make sure you use those stop losses, right? So the last thing we're going to talk about is how stocks are taxed, right? Because a lot of people don't understand how stocks are taxed, right? The first time I was 24 years old, the first time I ever did day trading, I made $15,000 that year, right? So during that year, when I made those $15,000, I didn't know I had to pay taxes. I come from a poor background. Nobody I ever known sold stocks or bought stocks. You know, most people just work regular jobs, got taxed through their paycheck. So I didn't know I had to pay taxes. I mean, I kind of knew, but I didn't understand. Like, I didn't know nothing about that. So I took the money and I had fun with it for 2 years. So by 6 years later, IRS writes me a letter and says I owe them like $6,000 in it. I'm like, what? $6,000, man? Yeah, you owe $6,000, man. 30%. You sold it all at a certain, and plus the penalties. So I ended up having to pay $6,000 back to the government 6 years later. Right? It's because I didn't understand the tax law. So stocks are taxed just like everything else, but they're taxed under something what's called a capital gains tax, right? And if you hold a stock for over a year, you're taxed at a lower rate than if you sell it under a year. If I buy a stock today, sell it tomorrow, I'm going to be taxed at a higher rate as opposed to if I sell it today, hold it for a year, and sell it next year, right? The most I can be taxed with a year, a long-term capital gain is 20%. The most I can be taxed with a short game is 35%. So regardless of your position, you're going to be taxed more on a short-term investment. If you do a long-term capital gains, you're taxed lower. Short-term, you're taxed higher because they see it as regular income. They don't see it as an investment if you don't hold it for over a year. So some stocks may benefit you to hold it for a year. If you're close to the year anyway, you might as well hold it for the year into the year zone, right? So all sale of stocks are what's called taxable events, right? The IRS, the SEC, both get a copy, right? So all we went over, right? We went over where stocks come from. We went over how the stock market works. We went over how to buy and sell stocks. We went over the different types of ways you can buy stocks, how to buy and sell a stock. And we finished up with the risk. We finished up talking about mutual funds and options. So with all of that, everything we went over, do you guys have any questions? Anything I can re-explain? Anything that we could talk about another way? So I want to make sure you guys leave with all this information. So are there any questions, guys? It's been a pretty quiet class. I guess you guys picked it up fast, hopefully. All right, last chance for questions, guys. I'll give you a minute or two, and then, guess I'll end it. All right, so no questions. So I want to make sure you guys know you're going to get a recording of this, right? You're going to get a recording of this after it's over. And like I said, if you guys have any questions, you have anything, you're setting up an account, you want me to take a look at it, you send me a screenshot, send me some questions, I'll answer them. If you write me on LinkedIn, you write me on Instagram, write me on Facebook, I'll answer those questions for you. I try to help as much as I can. I'm busy sometimes, so I may not get to the question for an hour, 2 hours, maybe the next day, but I'll try to answer them, right? So Sade asks, you can sell the contract to someone else to keep the profit. Yes, Sade, you sell the contract to somebody else. You never have to actually buy it. Like with that house example, I never actually bought the house. I sold the contract to a real estate agent. Same thing with stocks. You sell it to somebody else. You never have to nobody ever actually, this was called executing the option. That means actually buying the stock. Nobody ever actually does it. It's move the options, move the contracts around. So do you recommend buying an option of stock or just purchasing it? It depends on your situation, April. Options have a higher risk, right? And it requires a little bit more understanding than just stock. Buying a stock is easy. You buy it, wait for it to go up and sell it. Options are a little more complicated than that, right? There's time to expiry, different things like that. You have to understand it more, right? Because it doesn't necessarily go up with the stock. It depends on how far you got the option out for, different things like that. So it requires a little bit more knowledge, but it's something you guys should look into. So any sites to read for stocks? Well, I read Yahoo Finance, Google Finance, and a site called TradingView. And like I said, I have an options class this weekend. I'll give you guys the link. Hold on for a second. You guys are interested in that. We go deeper into options. We talk about options more. We talk about what they are. So with that class, if you guys want to get into options later, it'd be a good starting point. Give me a second. There we go. It's actually Sunday. Here's the link. I'll give you guys 50% off on that since you took this class. Give me a second. I'll give you a code. We'll call it stocks. Take 50% off. If you use the code stocks, STOP, use code. If you use that code, you'll get 50% off on that class. If you purchase it today, it's up to you guys. You know, I just want to provide it for you. But like I said, with this class, you can take this class. And like I do this class about 2 or 3 times a week. So if you guys ever want to retake this particular class, just write me, email me, or whatever. Say, look, I want to jump in this class, and I'll give you a code so you can jump back into it for free. So you don't have to pay for this class again. Because remember, every class may be a little different, right? So I talked about stuff in this class I may not talk about in the next class, right? The basics of it's the same, but people ask different questions. Like this is a small class. So you guys didn't ask a lot of questions, but some classes have like 20, 30, 40 people in it. I get a lot of questions. So it takes longer. So sometimes the class is 2 hours. Sometimes it's 2 hours and 10 minutes. This class is about an hour and a half. So some classes have different, we talk about different things. We talk about different scenarios. We do different examples. So if you guys didn't understand everything, take another class. Jump in another class. See, maybe you catch something you missed. Maybe another example comes up. Maybe somebody asked a question that that made you understand it better. So just reach out to me and I'll send you guys a code. So I'm going to give you guys one last chance for questions. I'm going to say, I hope you guys have a great night. I appreciate you joining the class. I hope that you guys are able to gain the knowledge tonight. I'm glad, I had a lot of fun tonight. I love teaching, so I love doing this, right? So I hope you guys have a great night, have a great rest of the week, and sleep well.